All right. Hey guys, thanks for joining us. I'm Patrick Wood. I'm the president and CEO of DelphX Capital Markets, and with me is my colleague Jonathan Deeter, head of capital markets in our New York office. Welcome to the first of what we intend to be a continuous episodic presentation on DelphX and our credit rating securities. As a public company, bringing out a new product to market and a product that is esoteric in a sense, such as credit rating securities. We're constantly asked by people, especially retail investors, to describe what it is that we are doing, how we're addressing it, what's our go-to-market strategy, and how does this what we are doing benefit them in the long run as shareholders of the company. So we thought it would be the right thing to do, to especially at this stage in our the company's evolution, to share with you more information and a better detailed breakdown on where we are and where we are headed as we enter a commercialization stage for the company. One of many that we've tried to achieve over the years, but with our new product, credit rating securities, the game has totally changed. So we couldn't be more excited as an organization to present to you more information and certainly more education on the market we're addressing and our products. So just a quick little bit of background. I've been in this business for 30 years. It started out bond trading. I've pretty much worn every hat there is. Structured products was probably one of the longer hats that I wore, and that was creating bond products, which had specific features around them for largely institutional investors. And so DelphX for me was a company that was very appealing in the sense that they were creating a new product back in 2017 or so, when I was first introduced to the company, that really had some interesting features to it, features that didn't exist in the marketplace, but features that made sense at the time. So unfortunately, DelphX, when it went public in 2018, things didn't work out for the company. And then, years later, I came into the role of CEO to look at what we were doing within the company itself, see if there was a foundational building block that we could build on and do something with that would save shareholders, including myself at the time, our investment. And so years later, 4 years after reluctantly taking on the role of CEO, we spent a lot of time cleaning the decks, really rebuilding a company, and not even rebuilding, but building a brand new company to get to where we are today. And that is a credit rating security. And a credit rating security it's a absolutely one of a kind and standalone product that addresses a need, and it fills a gap that doesn't exist in the bond market today. So really quickly, a lot of people ask, tell me more about the bond market. What is it that you guys, what's the total addressable market? All these types of things that normally come into a startup, and we're not necessarily a startup. Let's not call DelphX that. We've been around for a long time, but what is it that you guys are doing that would make me want to remain a shareholder or consider becoming a shareholder down the road? And like I said, that's why we decided that this format of us talking to you directly and starting on this, essentially in this format with us presenting, but eventually taking, questions from folks, et cetera, down the road as we continue this series. We thought that this is a no-brainer right now. And if folks are following the company, they'll notice we recently signed some partnership agreements that are non-binding that we're pulling together, but we've really made huge leaps and strides in the product, getting it to market, and going forward into the end of this year. We couldn't be more excited because there's an appetite for this product that just we really have validated now. And really have kind of nailed down. So with that, credit rating securities, I'm going to pass the baton off to John, but just really quickly, the bond market itself, before I do, it's the largest market in the world. Our first market that we're looking to penetrate as a company is a $17 trillion US corporate bond market. We're looking to get a small fragment of that market to adopt our product. Most importantly, the buyers of our product on one side, and the sellers of our product on the other. We've identified who the sellers are already. We already have them in pocket. Now our job is to bring the buyers to this party. And obviously with DelphX in the middle, and this is going to be broken down a lot more in future videos. We thought this was a good starter video, but we are in the middle. We issue these new securities. Essentially, we are almost like the order book for credit rating securities. And like I said, in the next video, we'll talk more about our commercialization methods, how we make money as an organization, and how our partners also benefit from this. But with that, I'll pass you on to John Deeter. He's our head of capital markets. He's in our New York office. John really leads and he spearheads, our sales efforts, and he's definitely, going to talk a little bit more right now about credit rating securities in particular. And then, like I said, in next episodes, we'll talk more about what it is that John's doing on the sales front, who he's identified, and not by name, of course, but what he's looking to target, and how that process is coming along. So, John, I'll pass it off to you.
Great. Well, thanks for the introduction, Pat. As Pat mentioned, Jonathan Deeter. I've been in New York for 10 plus years in various structured products roles, mostly at fintech companies, helping them scale from pre-revenue to well over 50 million in annual recurring revenue. So when I was approached by DelphX about the opportunity, I was super excited, especially given the total addressable market, as Pat mentioned. So in today's first session, really what we wanted to cover is what is a credit rating security, who are the parties at the table, and kind of how it works at a high level. And then in future sessions, we'll dig into more of the details. So I have a screen up right now that just breaks down the two different sides. So as you should view a credit rating security, we have our CRNs, which are the the sellers of the protection. So as Pat mentioned, we've signed 2 non-binding LOIs with major credit hedge funds who will really be the ones providing the funding for this product. So we're really excited. They're brand name hedge funds that will really carry weight here in this market. On the other side, then, who we've been marketing to are insurance companies, pension funds, asset managers. There's a huge market of firms that we can go after, and so what we're doing right now is bringing those two parties together in the middle. So DelphX will sit in the middle as the issuer. Our insurance companies and pension funds, the buyers of the protection. Why we're targeting them is they have massive portfolios of what are called BBB rated bond portfolios. So in 2020, when rates were essentially zero, what these insurance companies did is they loaded up on these BBB bonds because it was a smart investment for them at the time. As we've progressed further through the credit cycle and now entering a changing of the credit cycle, they're starting to feel a tremendous amount of pressure on those portfolios. Those BBB rated bonds are at risk of downgrade. And if that were to happen, the spread, the bid and the ask, the difference between that would blow out. And so essentially these long-term credit portfolio managers, they would get hit with huge losses. Another aspect of that is, as an insurance company, they have what are called capital charges. So they can only hold a specific amount of a certain rated category of bond. And if those bonds were then to fall into a lower rated category, they would essentially get dinged with a fee. And so what our product is designed to do is to help offset that fee so that they can get a little bit of a, we call a sleep at night pill that will help them offset some of those losses as they, face greater exposure to bonds that are downgraded. So as we've gone out to market, that has really resonated with the insurance companies. They've said, wow, this is a novel product. There's nothing like this in the market to date. This is something that will really help offset those losses because we do have a longer term vision on the bonds. So take Boeing, for example, the largest manufacturer of planes, they've been in the news recently for a lot of bad things, doors flying off of planes and other things. But long term, these insurance companies, they love the Boeing name and they want to hold that name. So in the interim, enter DelphX, and they see DelphX as a solution to help offset some of those short-term to medium-term losses that they will incur from capital charges, spreads blowing out. Their credit committees may make them sell the bond, but they don't want to because they're long the name. So DelphX has created our credit rating securities to help mitigate some of those losses in the meantime. I'll pause there. That's a real high level introduction. As mentioned on the other side, we have a couple hedge funds at the table who have agreed to provide the funding for the product, but there are a handful of other hedge funds here in New York, around the country, who have seen the product, seen the docs, seen the terms and the pricing, and who have said, as soon as this market gets going, we'd want to be players in this market. So that's really exciting from DelphX's perspective, because it really shows the size of the market. It's not just the two players at first. There will be others then that will come into this. And we've seen this in the past with, the CDS market, the CDO market, other novel credit products that, started from square zero, like DelphX is starting. But, people have said like, wow, we've seen similar trades like this in the past, but DelphX is so much further along in terms of doc creation. All of our docs are standardized and ready to go. They're turnkeys. So, as soon as we have other players coming to the table, those things are standardized, which is a huge lift. And that's really where we have a head start in the market, is that those are standardized and ready to go. But then also just familiarity, having these hedge fund partners will really bring a brand names behind the DelphX brand that will help us then market to the insurance companies, the pension funds, and the asset managers of the world. Pat,
great, John.
John, in our first,
I think that's a great rundown, buddy, for sure. I think it would be helpful if we could also walk people just through kind of the structure today,
sure,
of how a credit rating security kind of works, and then I would suggest for our next video, then we can really dig into our commercialization strategy.
Awesome.
And really share with shareholders and others, where we are, because I think between now and our next video, we'll have a lot more kind of information which will be more relevant. But once again, I'll pass it off to you. Sorry for interjecting, but I'm interested to see the schematic again and get a walkthrough.
Awesome. Well, I have a screen that I'm sharing here that you guys should be able to see. So really, we'll break down the two sides of the transaction with DelphX's role in the middle. So on the left-hand side, the CPO, the collateralized put obligation. So for all of you, investors that are familiar with buying puts on the stock, this is going to operate, very similarly. So you have you think something's going to go down in the short term. So as an insurance company, you're buying a small amount of protection on your bond position. So let's just use an example of, you have a $200 million position in Boeing. What you're going to do up front is you're going to pay $2 million to have that little sleep at night protection. That $2 million then is going to be sent to our custodian, Bank of New York, brand name. They're going to hold that $2 million and they're going to send it then to the hedge fund. What the hedge fund then is going to do is they're going to put up an additional $6 million. So we'll have $8 million sitting with our custodian that then will be invested in treasury. So that will be collecting interest. In the event of a downgrade, then that premium that is collecting interest will then be paid out back to the insurance company. And how that'll be calculated is based on the spread widening and the duration left on the bond. So the duration is just, how much time would they have until maturity? That will determine the payout for each bond. So for each position, ideally how these will be structured is, one bond, one note. If a insurance company has multiple bonds that they want to write, this might be 15 transactions, 30 transactions. Hedge fund on the other side, they're going to be writing this protection, so putting up that additional $6 million in collateral. If no downgrade happens, insurance company doesn't collect anything, hedge fund keeps their money. How DelphX makes money is in the middle. We're taking a minimum of 100 grand per transaction, or we're taking 10% of that premium. So as you can see, as these things start to get going, the size, the volume, the initial interest has been on portfolios of 30 bonds. So you can see then as this starts to get going, that ends up being a lot of money, both for DelphX, but then also the insurance company in the event of a downgrade, or the hedge funds in the event of nothing happens. So Either way, DelphX is making money in the middle, which is what's super exciting for us, and I think why we're so excited about the growth of this product. But then also, as we start to get going, people have expressed doing this on buckets and baskets of portfolios, which is really where we see this thing growing. I'll pause there. Pat, anything structurally you
No,
want to
John,
touch on in addition to that?
so I think that's a great starting point to kind of give people something to chew on here. I think to kind of beef that up a bit. Looking at this product and looking at DelphX, this is a standalone product. Nobody else has ever thought about this product before. And what makes it really unique is, with all the other products out there that bond investors use to protect themselves, this is the only one which really one protects you for the duration of the bond, so for the actual underlying holding, but that also is triggered on downgrades. And downgrades, this is one of the main reasons why we created this particular product. Downgrades, as John mentioned, for insurance companies are an absolute, they're the worst thing ever, because not only do you lose value on the bond, but you also then have to increase your capital charges, and in some cases you're actually forced to sell the bond. So what we've done is we've addressed a pain point, and we've brought a painkiller here to the market that never existed before. And that's why, hedge funds now have said, gosh, we love this trade. We want to be a part of this, and we want to fund it infinitum. And then we also know now with, at least 85 bonds provided to us by insurance companies that, we have a very big appetite now from insurance companies to use the product as well. So as John mentioned, our next steps are, and certainly we've already done quite a bit of this, is just to bring these two parties together. And now that they are, we're definitely on the right path to bringing this very novel, but let's face it, for the layperson, somebody who's not in the bond market, this is a very esoteric, very difficult product to understand. But our goal is to really make it easy for folks to really kind of to get involved in and understand. So this is the first of like I said, many of these that we intend to do. We'll do one again, I think, in the next week or so, possibly sooner, possibly a little bit later. But in the meantime, if people have questions, they can always reach out to the company. We're always available. We're on all the press releases. So George or myself, you can send an email to us.